Welcome, everyone, to our fourth quarter market commentary. Hao and I are back to talk about the results of the third quarter and our outlook for the coming quarter. So on today's episode, which will be aired on YouTube and a bonus episode in the podcast, we are going to talk about King Dollar, just the strength of the dollar this year and some interesting things to unfold there. The Federal Reserve seems to be done or very close to it with their job in raising interest rates. Series I bonds. We talk about this a little bit more on our episode 34 of the pod, which was released on Wednesday, October 11th. But just what yields are looking like there and some commentary that we have on should you cash them out. Market performance year to date. And finally, what is our outlook for the coming quarter? All right, Hal, I'm going to turn it over to you, sir. And let's kick us off with King Dollar. Cash is king right now. What's going on in the cash markets?
Yeah, U.S. cash is king relative to every other currency, right? In spite of all the naysayers, I think we've addressed that quite a few times. A couple of things, the strength of the U.S. economy or the persistence of it. I know the Fed is trying to mightily slow us down, but couple that with higher rates, also the Fed's doing, and couple that with other geopolitical issues across the world, right? I know we have our problems, but again, I don't know what other country you would rather be in other than the U.S. at the very moment. We're recording this when news of the Middle East conflicts flaring up again. So yeah. Israel and Hamas is currently in the heat of battle. So again, our thoughts are with all the people in the Middle East right now, and again, a lot of people in the collateral damage range of that. So where would you rather be in terms of economics? I think the U.S. is showing strength. Lots of other issues are coming up from countries around the world, right? So you look at Europe, look at China, look at South America even, right? There's a lot of holes in their economy or potential pitfalls that are causing their currencies to weaken relative to ours. And because of that, it's been really good to be a U.S. traveler in these foreign countries. And that's because the dollar is going a lot further than it has been in quite a while. That's because, one, our strong economy and our relatively higher interest rates, right? So those two coupled are strengthening the U.S. dollar.
Mm-hmm. And you commented on this about how the strength of the dollar, or can you comment on how the strength of the dollar has impacted foreign investment holdings in the last year or two?
Yeah, I think that the strength and the appeal of higher yields is attracting foreign dollars from sovereign and individual foreign investors, right, into U.S. companies, which, if you're going to buy, the S&P, right, those are all U.S. companies, even though a lot of their income is generated overseas. Their investments are in U.S. dollar denomination. So if you like Google or Microsoft or Apple or Amazon, right, you're investing your foreign dollars, converting them to U.S. dollars, and investing in U.S. companies.
40% of total revenue generated by S&P 500 companies comes from overseas, and so I think what you're getting at is if I have a currency, a single value of insert whatever currency and another currency, I might find it more attractive to transfer that into U.S. dollars or exchange that into U.S. dollars and then buy a U.S. dollar denominated stock, and I still have some international exposure. Yeah. Even if I just do something as simple as buy the S&P 500, because these companies are earning 40% of their revenue from outside of the walls of the United States.
Correct, yeah. And if you're a Canadian investor, you're going to buy the equivalent of what the S&P 500, but it's going to be our U.S. S&P 500. So I don't know if you have to convert Canadian dollars to U.S. dollars to make that investment, but once you're buying that U.S. stock basket, right, you're owning predominantly U.S. generated businesses, right? Yeah. I know there's the worldly component to it, but I think wanting to invest in the U.S. right there, I'm using the Canadian investor as an example, but that's that's helping push up our stock market as well, and our currency.
And you also commented on how the strength of the dollar has, against foreign currencies, has actually propelled the returns of emerging markets in international over the last year. Can you speak a little bit more about why that happens?
Yeah. In a weird sense, the strong dollar, right, has made every other currency cheaper, relatively speaking. So if you're Tesla, that can hurt you because you're trying to sell in China, but the Teslas are somewhat pegged to the U.S. dollar. But if it takes more Chinese yuan to buy that Tesla, it's seemingly more expensive to a Chinese person wanting to buy a Tesla or not. On the flip side, if the U.S. dollar strengthens, right, international companies are selling or exporting their goods to the U.S. at a relatively, from our point of view, a cheaper price, right? So China would benefit from this. A lot of European countries that ship to the U.S., car manufacturers, foreign specifically, like Japanese and European cars, they're able to sell their products at which much more ease. There's less friction there because their value of their currency is kind of pegged to what they know, but that looks cheap to us, relatively speaking.
Interesting. Okay. Thanks for sharing. Let's move to the Fed. So the Fed has been on the most aggressive rate increases in many, many years or ever. We tend to think that they are close to done or done. But what's that done for cash rates, and what are some of the landmines that could be out there for investors?
Yeah, well, raising rates was to tame inflation, right? So that's first and foremost is we got to hit the 2% target according to the Fed. Right now, inflation's at 3% if we're just stripping out food and oil. 3% still high, and I know you're probably screaming in your phone or wherever you're listening, where prices are higher, prices are higher. Yes, that's price level, right? The level of everything has gone up, right? If we're going to get cauliflower, I think it was the last time you checked, it was $5 a head. So,
I almost texted you the other day, by the way. I'm actually seeing prices come down at the grocery store. I don't know if you're seeing that where you are, but 30 cents, 50 cents, like things are actually coming down. And it's not like a sale price anymore, because we talked about this a couple of weeks ago. Prices were falling, but due to sales. But this is like actually the sticker that has the normal price. That's the always price.
Yeah.
And it literally is like 30 to 50 cents lower on a lot of the items that we buy, which is your typical, pantry items and fridge items that everybody has.
Correct. Yeah. So I want to make a difference between the level of price gone up, right? that journey of the price going from, let's say, $1 to $1.50, that 50-cent difference is the inflation, right? So now we're looking at $1.50 good, and if it stays at $1.50, there's zero inflation. That's what we mean by that inflation target. So if it goes to $1.51, you're still angry because you're used to paying $1 for that thing. Now it's $1.51.
Yeah.
But what we're describing is that penny difference.
It's the rate of growth that's trying to slow. And so I think what we all hope is that prices actually go down, which would be deflation, which is actually a bad thing. But we want the rate of inflation to slow dramatically, correct?
Yes. And I'll get into why deflation, right? Just look at Japan. Why, believe it or not, their rates are negative, right? If you had $100 in a Japanese bank, you're getting negative 0.01% on your money. So somehow they're taking money out of your account to make that work, right? So I think
it's like a Bank of America fee.
yeah, but it's driven by the Bank of Japan. But it's so knowing that you're going to pull your never deposit your money while that's happening. You're going to spend it or invest it somewhere else, right? That should hopefully spur economic growth, which inflation is a byproduct of that growth, right? You get deflation when people are unwilling to buy your good, right? Let's say you're Pepsi and you raise prices and people stop buying Pepsi products. You're going to start lowering your prices, and all of a sudden you're not viewed as a premium brand or whatever the case is. We've talked about Lululemon being hesitant to lower their prices. Deflation, I know this sounds weird, lower prices is not good for an economy. And I think that's the bottom line of what we're trying to say is why the dollar's strong, the economy's strong, rates are higher relative to Japan. Economy is rebounding, but rates are negative. You could see the imbalance between the currencies there.
And so all of this has led to people's savings accounts, maybe not your big bank savings accounts, but think of like high yield savings accounts and money markets and this type of thing. All of this has led to the U.S. is paying some of the highest interest rates in the world, and we have the highest credit quality in the world here in the U.S. And so, historically, you would assume if there's lower credit quality or higher chances of default, that institution or country would have to pay more in interest in order to attract capital. That's not the case right now. The U.S. is paying some of the highest interest rates in the world, and their currency is incredibly stable.
Yeah.
Let's shift over to that for a moment. So high yield savings accounts, CDs, money markets. I mean, we're touching in the fives, sometimes in the mid fives. What has this done for savers, and what are some of the landmines that are out there with some of these money market instruments if the Fed is maybe near their end of their rate hiking cycle?
Yeah. So to kill that inflation target, right, of 3%, they want to get it down to 2%. The Fed is keeping rates higher for longer. As Chris described, they were hovering around 5%. You could probably find rates around 5.5%, but that trickles into savers, yes. Like if you have money in the bank, you're getting a pretty nice yield if you have a high yield savings. Mm-hmm. But on the flip side, if you're a borrower, you most likely are paying 7% on a car, right? Mm-hmm. You're paying 7.5% on a mortgage. This is not a good time to be borrowing money, but that's the point, is the Fed wants people to slow their spending, and they're incentivizing people to save more and disincentivizing them to not spend more, right? And that's what we call it, a lag effect, where these hikes have 6 to 18-month lag, where if I'm raising rates today, I probably won't see it for nearly 2 years, the impact of it, especially with mortgages, right? The only new mortgages that are cycling in, that only counts for like 5% of the mortgage activity or the homeowner activity, right? Mm-hmm. Not every single house in your neighborhood is going to turn over and everyone's going to get 8% loan, but it's a small portion, right? I don't know how many houses in your neighborhood are for sale. There's very little in mine.
I think I was seeing quarter over quarter, it was actually down in terms of listings and closed sales and stuff. It was down, I don't know, 5%, 10%, just from the last quarter, which could be seasonal, right? That's common, but I don't know that seasonal adjustments actually happened in the last few years. Like nothing has slowed down over the holidays. Yeah,
and let's go back to the saver side of it, where there's a big benefit for saving, right? Or being able to spend without tapping credit. And I think that's been great for people who have money in the bank, earning 5% if they could find it. And we'll get to that, it's like the struggles we've had today trying to find something that consistently pays that, right?
I was going to say, should we talk about that?
I think we should.
Okay. Let me just set this up real quick. So as you can imagine, we have a lot of clients reaching out to us going, how can I earn more on my cash? I've got a Chase account or a Bank of America account and I'm earning, 0.01. How do I change that? And so, people are inquiring about money markets or CDs or these types of things. We had this one instance where we were trying to buy CDs for 2 and 3 and 4 year periods to try to lock in longer. And what did we find in that?
Next to nothing. It was pretty bad. Yeah. So CDs aren't something you could pluck out of the sky, right? Because a bank has to commit to paying you on that particular certificate of deposit, right? Let's say you want $100,000, and Bank of America, and we're not speaking hypothetically, Bank of America does not need your money. I've yet to see a Bank of America CD, outstanding CD.
Yeah, somebody please send in a picture when you drive by the B of A that has the giant sign out front that says 5% lock for 2 years. They don't need your money, so they aren't offering that.
The manager took that poster down and ripped it up.
Yeah, that's right.
They don't need new deposits. The amount of money market flows that have come in all year, even this year on a good up market, has been record breaking, right? So
when we pull, carry on.
So when we pull a list of available CDs, meaning banks are willing to borrow this much in deposits, I think we haven't seen so little demand from the bank side.
And we're only seeing regional banks on there.
Only regional banks, yeah.
So it's very few big banks, like none.
None from JP Morgan or Wells Fargo or...
Yeah, none of those. So it's regional banks that are sort of needing your money, but at the same time, regional bank lending has dramatically come down. And so that's why volume of CDs has gone down. And volume is just this, banks have reserve requirements. If they're lending a lot of money, they need to hold money in reserves to back those loans. Well, if I'm a bank, XYZ Community Bank, I'm not just issuing an unlimited amount of 5% 2-year CDs.
No,
I might list
not good for business.
$1 million,
Yeah.
and then it fills up because I just need that $1 million in order to be the collateral on the loans that I just loaned out. Right? That's how banking works.
Yeah.
What we're finding when we pull these is, even if you go to like Fidelity.com and you look at CD rates, you can get in the 5s or mid 5s all the way out to a 10-year CD. No, you can't. Like it says it on the website, you cannot buy that CD. It doesn't actually exist.
Not without strings, correct? Yeah.
Or the strings are, it's callable. And can you explain what a callable bond or CD means? And what are you seeing in the marketplace there?
Yeah. So think of them as the bank as a borrower. They're borrowing money from you, right? So what they're putting a call feature on is, I have a right to pay you back your money before the maturity date. So if, let's say I buy a 3-year CD, I'm going to put a call after year 1 because I know when I'm
So
a bank.
3-year CD, 5.5%. You're feeling good. You bought it. You're like, I got this 3 years, 5.5%, but it has a 1-year call on it.
Yes. In 2024, because I'm a bank, I know my forecasts for interest rates. I'm forecasting they're going down. I'm going to plug in a call feature after 1 year and not be on the hook to pay you 5% when the market is suddenly down to 3%, right?
You basically get refinanced out of your own CD.
You do. Yep. Yes, and you have no choice about it.
Yeah.
And yes, the majority of CDs that we see available right now, and this is the day after the Middle East conflict, we've had 20 new CD issues from a country full of banks. There should be thousands of these things available.
We talk CDs just because they're kind of one step away from a money market, right? You've got a bank account, and then you've got a money market, and then a CD, which is a bank product. It's FDIC insured, but it's very simple. You know, you buy the product, it pays you interest, the product turns back to cash. That's it.
Yep.
And otherwise, you get into bonds, and that's government bonds, corporate bonds, all these other things, which are slightly different sort of instruments because you often will pay more or less than the par rate. So if it's $1,000 bond, you might not buy it for $1,000 and get $1,000 back. You might buy it for $987 or $1,020, and then you get $1,000. So anyway, that gets more complicated. We're just talking CDs because they're a very straightforward banking product.
Yeah. And I think taking a picture of a CD rate that your bank is advertising is a bit facetious, but it is the truth. I bet if you're going to go to your Bank of America and the banker puts a interest rate sheet in front of you, you're not going to see those 5%. You're going to see what they call a preferred rate, and you're going to see maybe 2% for a 2-year CD. Because especially the bigger the banks who have taken in all this money since Silicon Valley this year, one thing they don't need more of is more cash.
Yeah, right.
Yeah. So you're seeing that kind of reaction, even though you're seeing on Bloomberg or CNN that rates are so easy to earn 5% on. You know, me and Chris wish you luck.
Okay, let's move to Series I bonds, the most popular topic of what was that, November of 2021?
Yeah.
When that rate jumped to, was it 7.12?
9.62.
Yeah, but it was 7 before it was 9.
7.12. Yeah. It peaked at 9.62.
Yeah, so let's just unpack this quickly. And for our listeners, we are talking about this more on episode 34 of the pod, which airs October 11th. And if you're a subscriber, it'll be right in your inbox and on your phones. But if you're not a subscriber, well, you should become a subscriber, and then it'll just be on your phone. But let's just talk briefly about Series I bonds, in part to just educate what's going on, and a slight infomercial to listen to our episode 34.
Yeah, well, Series I bonds, we've been on this since the date Chris mentioned, November 21st of 2021, right?
Mm-hmm.
The rate hadn't quite peaked, but everyone was saying, "Hey, these new bonds, they weren't quite new; they were decades old, right?" But they didn't pay a yield because inflation was nearly non-existent in the U.S. for 40 years. So they a product being tagged to inflation. We don't have inflation, you suddenly don't have yield. But when you have inflation, like you did in 2021, you have yield again.
Mm-hmm.
And over the last 18 months, I think, Chris, right? We had a lot of interest in these types of bonds, and I think we were happy to at least talk about it with clientele. Where else were you going to get a pretty stable bond that was paying nearly 10%?
Yeah. And I think that the people that got in November of 2021, right when the rate spiked, so the rate went from 3.54 to 7.12, and I think that's when the media jumped on it.
Yeah.
And everybody saw these articles, we started hearing about it. The people that bought those have done pretty well because it went from 7.12 to 9.62 for the next 6 months. Then it went to 6.89 for the 6 months after that. And then now, for the 6 months after that, so May of 2023 to October of 2023, 4.3, and the new rate has not yet been announced, but when it is, it potentially would be lower. So anyway, if you got in November 2021, you probably did well. Our point is just that those rates are coming down. That's actually a good thing because inflation's coming down.
Inflation's down, yeah.
But we just wanted to highlight it.
Yeah, and I think we use that topic on the back of CDs because CDs are the topic du jour now, and we're saying how hard it is to access a full 5% if you want to go out further than a year, especially at a big bank. The same folly was with iShares or iBonds because they were so appealing in a environment that wasn't great for bonds, right? And now CDs, money markets are probably worse than CDs because they reset every 7 days, right? The appeal there, yes, definitely attractive. Try to get those yields while you can on your cash, but not consider cash that should be invested, right, as a substitute to buy these CDs, and think of it as a long-term investment because they're not. We know rates are coming down. It's a matter of when. I think they're going to be sooner than a lot of people expect. Yeah. And I think the reset on iBonds have surprised people how fast they came down, right? And people only enjoyed that 9.6% for 6 months.
Good point. So there's a couple things that I want to highlight here before we move on. So there is a lot of historical data on when the Fed goes through a hiking cycle, what it does to interest rates, and then what happens after the Fed ends their hiking cycle, and how does that work with bonds. And I think the key that we want to highlight here is that when you buy a very, very short-term bond instrument, like a money market, Howe says that's a 7-day instrument, meaning they're literally buying 7-day bonds that mature in 7 days, which means that rate will reset every week. And so when rates start to fall, that rate will start to fall in lockstep and immediately. Whereas if you can buy a longer dated bond, 1 year, 2 year, 10 years, you have that rate locked for a period of time, assuming it's not callable. Now what that does is if you bought the bond today at 5%, if you can find it, and rates then go to 4 or 3 or 2, your bond that's paying 5% is worth more because it's paying an above market rate. So what I want to kind of set up here and just frame for our listeners is if the Fed really is near the end of their hiking program for this cycle, when you look at forward-looking 12 months, so from today forward 12 months, the rate of return on cash, so like high yield savings accounts, money markets, historically is about 4.5%, versus if you look at just core bonds like the AGG or the AG, the AGG would be an ETF, 11.5% is the return there. And that's in part because you're earning more on interest because these bonds are paying more, and in part because rates fell, which made the value of your bonds go up because your bonds were paying an above market rate. So that's point one. Point two is when the Fed rate is currently higher than inflation, which it is, for the forward-looking 12 months, returns on cash or money markets is 5.1 and core bonds 7.5. And finally, everyone's favorite topic, when the yield curve is inverted, problem with that means that short-term bonds are paying more than long-term bonds. So what do we all want to do? Buy the short-term bonds because they're paying more, sometimes by a couple of percent.
Yeah.
But that pulls us into the reinvestment risk when those bonds are maturing, which could be as soon as 7 days. Forward-looking returns on cash only about 4% versus core bonds 7.8. So yes, all of this is pointing to longer-term bonds. Our point is just if the Fed is really near the end of their rate cycle, we just want to caution people with sort of the mirage of these high-yield savings accounts right now, which are paying a lot, but that likely won't carry on forever.
Correct.
Final point here is when the Fed stops hiking, rates start to adjust immediately. We talk about this a lot on this podcast and a lot on our shows, priced in. The market tries to anticipate what happens in the future and price it in to current pricing. When the Fed comes out and they raise rates, for example, sometimes interest rates don't move at all because it was anticipated, therefore it's already priced in. So the market will soon start to price in. In fact, maybe they already have due to this conflict that we now have that's erupted. The market has seemed to have priced in the Fed might cut sooner, which is interesting, right? Rates tend to fall really fast once the Fed stops hiking because the market tries to price in that. 1 month after the final rate hike, the average fall in yield is about 0.25%. 3 months after the Fed stopped hiking, the average yield fall is almost 0.75%, and 5 months after, it's a full percentage point. Yeah. So really gets priced in very quickly, which is, again, interesting and just something to be aware of, that if somebody's trying to skip from their money market account into a CD or a bond, that yield might fall off really, really quick once the Fed does reach their end of their rate hiking cycle and once that gets fully priced in.
And I think, to be clear, we are not trying to burst the bubble of that 5% riskless return. It's just you got to think ahead on this stuff sometimes, right? If you fall completely in love with I-bonds, you get the I-bond rate of 4.3%, a year and a half after the fact.
Yep.
I think it's setting up for disappointment if you're so hyper-focused on one type of investment over like a more diversified portfolio.
Great. Okay, let's move to stocks, our final topic for today. So we'll do a quick review of where stocks were last year, where they are so far this year, and then finally, what is our outlook for the coming quarter?
Yeah, we bring up last year just simply because heading into this year, last year was so tough that no one had any optimism coming into this year. I'll point out one of our year-end newsletters where we said buy new large cap growth, not because we thought the economy was going to be on fire or we foresaw AI or anything. It's just because valuations. We said buy blue chip growth stocks, and they were cheap at the time, simply because those very stocks were down 33% at the end of the year, to end the year in 2022. So their toward pace in this year was simply just kind of gaining back what they lost in the year previous. All right. So if you're looking at it in a year in, year out bubble, yeah, you're missing the forest for the trees because you're focusing on one good year on the back of one bad year. And if you level those two out, they're pretty flat in terms of what the performance was, right? So heading into the year, there were zero people saying that the S&P was going to be up, 12% on the year? And there were a lot more people who were saying, watch out, right? The recession's coming. Go to cash or buy safe investments. And where are they? They're still singing the same tune, but no apology about missing, a pretty good 10-month rally. And I'm including September and October, August and September, because August and September we have data going back to 1945 from the Wall Street Journal. They broke down all the months of performance in stock market, right? The worst 2 months in a calendar year, believe it or not, were September and August. September being the worst for some reason. And on average...
Good we're through that. Glad we're not recording this in September.
Yeah, I know, rough month.
Yeah.
But on average, October, November, December in that grouping, which we're in right now, have historically been the best performing months in the year going back to 1945. Again, with all the new stuff that's coming out in the last 2 days, I don't know if history is going to repeat itself, but it does tend to rhyme. And if it wasn't even a correction, so the S&P sold off maybe 7% from its peak in late July to now. So corrections considered 10%. I think we already had that in March. Typically, you actually should anticipate a 10% pullback at least once a year.
15, yeah.
Right?
Yeah.
So maybe we're done, maybe we're not. But again, any reason to sell should be more plan-driven than event-driven.
Okay, so that's sort of the year in review, and let's hit a couple of hot button topics. Government shutdowns. I know we averted that in the short term. What's the data say on government shutdowns, and how does it impact markets?
Yeah. Again, good luck trying to time government shutdown reactions from the market. We have another chart that looks at the data going back to the last 17. I can't count that high. 17 shutdowns.
Yeah.
Apparently, it's pretty common with our government, and it probably shouldn't surprise listeners. So, the last one was in 2019. The market was up 11%. The one before that, 2018, the market was up 2%. In 2013, the market was up 4%. The last time a government shutdown had a negative market impact, and again, we don't know if it's going to be related to government shutdown, was in 1990. And it's pretty mixed since then. The last time we had a severe drop, and I don't really consider this severe, was 1979 when it was down 4.5%. So not a lot of trending data. Again, government shutdowns are never fun, but they don't really impact the markets from our point of view.
And finally, our outlook. What's going to be top of news, we think, this quarter, and how's it going to impact either sentiment of our clients or markets?
Well, we are expecting, I guess we tend to expect upward tilting markets because that's just how history has worked out. But this heading into 2024 is unique because it happens every 4 years. It's the presidential election, so I think we're going to see a lot of rhetoric, a lot of finger pointing, right? The party out of power is going to say how crummy your life is, and the party in power is saying how much I improved your life in the last 4 years. Unfortunately, they don't have too much impact on our day-to-day or even our dollars, right? So our newsletter has data tracking back to 1928, and whether Republican or Democratic president, the S&P returns have been pretty random. Some presidents have good returns. Broadly, they mostly do because the economy has been growing since 1928. But I think people way too much of their investment thoughts on presidencies and politics, and I think we're trying to prepare everyone for a lot of rhetoric coming up.
I feel like this year, our every other podcast, we talked about interest rates and the Fed, and I feel like next year we're going to talk about politics, not in the political sense, but hey, it probably doesn't matter, and kind of deflecting a lot of the, if this person wins or that person wins, what is it going to do to markets? There's just so much data that it's just hard to get a lot of things done in a 4-year period to really materially change economic outcomes. And oftentimes the data would suggest the economy that president inherited is much more of a predictor on those economic results or the stock market results than the economy that is perceived that they created. Now, of course, in their campaigning, they will always, whether it's a good market or a bad market, they're going to spin whatever the most positive thing is, whether it was job growth or we look at the stock market or whatever. But historically speaking, when you really cross-reference those comments with actual data, presidents don't really have an absolute growth or fall of really any sort of aspect of the stock market.
Yeah, I think you should be paying more attention to the Fed as fun as that sounds, it's just they have more of an impact on our economy than Joe Biden or Donald Trump.
Yeah, fair. Well, consider that everyone's first reminder of this message, and we'll be back in 2 weeks to say that same thing again.
Unfortunately, you're going to hear that a lot from us.
Okay, wonderful. Any final thoughts or anything else that you wanted to cover?
Real quick, emerging markets. I think that's been a thorn on every investor's side, at least if they were properly diversified. And I'm talking from an institutional sense, right? Because every money manager out there is saying you should have emerging markets. Valuations are cheap. Their middle classes are growing, right? And we're speaking India, China, South America, where yes, the demographic shifts make sense, but we have yet to see any rewards for all the risks that those regions pose, right? So I think there is a need to look at it long and hard, what your exposures are in, and whether they're a great diversifier. Again, we could talk about diversifiers, right? You don't want everything moving up and down at the same exact time, right? That's not a good portfolio, because if they're all moving up and down at the same time, might as well just buy one thing and forget about it.
Yeah, what's the point in being diversified if they're all doing the same thing?
So that's where emerging markets came in, where if America wasn't doing good or international developed markets weren't doing good, here comes emerging markets to save us. But I'll talk to China specifically, they've always found a way to shoot themselves in the foot. And I think it's hard to look past some of the big warts with some of those investments.
I just saw the Evergrande in the news again.
Yeah.
And I feel like when that all broke not that long ago, it was big news, and U.S. markets even reacted to it. And I see an article about it periodically, and it's like, nobody cares. So I think that could be a big issue, but it's just not really top of mind for anybody anymore.
Yeah, for background, Evergrande was a big Chinese construction developer that over-levered and overbuilt, right? You could see Chinese ghost towns of brand new constructed towers of residential buildings that are unoccupied. So one, if you can't stay in business with that kind of model where you build and no one pays you for the building.
Don't sell.
So that has a lot of economic ripple effects in China, and I think that will be years of unraveling. Unfortunately, for a country like China, where they've invested so much in their construction companies, and they've overdid it. And we've done it. So not to really point fingers at China, but again, they're kind of repeating some of the mistakes that other countries have made.
All right. Well, that's it for today's summary, and this will be posted with our quarter 4 client newsletter. So this will be posted to our website in the market commentary section. You'll have access to this market brief as well as the YouTube and the bonus episode of the podcast. So we hope this was helpful for everybody. And just let us know if you have any questions at team@consiliowealth.com. And as always, if you like this, please like and subscribe to our content. We have lots more stuff that comes out. We have a podcast that we release every 2 weeks, which is top of mind commentary. We have a YouTube channel where we cover 2 to 8 minute videos on super helpful things, backdoor Roths and mega backdoor Roths, and the new Washington State long-term capital gains tax and all these sorts of things. And our objective with that is to teach people these little nuggets in 2 to 8 minutes. That segment is called Consilio University. So thanks everybody for tuning in with us today, and we'll catch you again soon.